Every day, billions of shares change hands. Prices move every second. The screen shows a number for Apple, a number for Tesla, a number for Amazon. But who actually decides that Apple is worth $200 a share instead of $199? Is there a person in a room somewhere? A committee? An algorithm that does the math? The answer might surprise you. No one sets the price. Not really. What you see on your screen is not a verdict. It is not a calculation of what a company is truly worth. It is a record. It is the price of the last trade that just happened. And understanding what that means changes everything about how you see the stock market. Let us start with the most important distinction in all of investing, the difference between price and value. These two words are used interchangeably in everyday conversation, but in finance they mean completely different things. Value is an estimate. It is what you think a business might be worth based on its assets, its earnings, its future potential. Think of it like getting a professional appraisal for a house. Someone looks at the size, the location, the condition of the roof, recent sales of similar houses, and they make a calculated guess. That is valuation. It is subjective, it is slow to change, and it is always an opinion. Price is different. Price is the actual dollar amount at which a house sells at an auction. It is objective, it is real, it is the money that changes hands, and it changes every second. A company can be incredibly valuable with growing earnings and a strong balance sheet. But if investors suddenly panic, the price can drop like a stone, regardless of the company's actual health. Valuation influences price over the long term. If a company continues to grow, its valuation usually goes up, pulling the price higher. But in the short term, price ignores valuation completely. So if price is not a measure of value, what is it? Price is the point of agreement between a buyer and a seller at a specific moment in time. That is all. It is not the highest price anyone in the room would have paid. It is not the lowest price anyone would have accepted. It is simply the price at which two people actually traded. This specific transaction is known as the marginal trade. It is the margin of agreement between a buyer and a seller right now. Once this trade happens, that price becomes the market price. Imagine you walk into a coffee shop. You want a latte. The board says $5. You are willing to pay up to $5.50, but you do not need to because the price is already set. Another customer walks in. They really need coffee right now and would have paid $6. The barista says $5, please. You hand over the money. The price is $5. Not because that was the highest anyone would have paid, but because it was the price the seller set and you agreed to. The other customer's willingness to pay $6 is invisible to the transaction. Your own willingness to pay $5.50 is invisible too. Price only captures the moment of actual exchange. Now, here is where the analogy breaks down and the stock market gets interesting. In a coffee shop, the barista sets the price. In the stock market, there is no barista. Price emerges from a continuous stream of buyers and sellers posting orders. The stock market is, in essence, an auction. One party wants to sell its ownership in a particular company. Another party wants to buy ownership. When the two parties agree on a price, the trade is matched, and that becomes the new market quotation for the stock. The forces that drive this auction are supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell a stock than buy it, the price goes down. This is the simplest and most fundamental explanation for why prices move. But it raises an immediate question. What makes more people want to buy or sell? What actually drives supply and demand? Answer is information. Information comes in many forms. A company announces stronger than expected earnings, and suddenly more people want to buy. An economic report shows rising inflation, and investors worry about what that means for the future, so they sell. A competitor launches a superior product, and the outlook for the company dims. A political event creates uncertainty. A natural disaster disrupts supply chains. All of these things change what investors expect about the future. And because stock prices are based on investors' expectations of the future value of a company, any new information that changes those expectations will change the price. But the mechanics of how this actually happens on an exchange are worth understanding because they reveal something important about the nature of markets. Behind the scenes of every trading platform is something called the order book. It is a real-time list of all the buy and sell orders that investors have placed. Buyers state the maximum price they are willing to pay. These are called bids. Sellers state the minimum price they are willing to accept. These are called asks. The difference between the highest bid and the lowest ask is called the bid-ask spread. When you place a market order to buy a stock, you are saying, "I want to buy this stock right now at whatever the best available price is." Your order will be matched with the lowest ask, and you will pay that price. When you place a limit order, you are saying, "I am willing to buy this stock, but only if I can get it for this price or less." Your order goes into the order book and waits until a seller agrees to your price. Every trade that happens is a match between a bid and an ask. The exchange broadcasts that executed price to the market, and that becomes the new quoted price. This cycle can occur thousands of times per second for actively traded securities. Now, what happens when there is a gap between the highest bid and the lowest ask? In a perfectly liquid market, the spread might be just 1 cent. But in less actively traded stocks, the spread can be much wider. This is where market makers come in. Market makers are financial institutions or specialized trading firms that facilitate trading by providing liquidity. They continuously quote both a bid and an ask price for a given stock, standing ready to buy and sell at those publicly quoted prices. They profit from the spread, buying at the bid and selling at the ask. By doing this, they ensure that there are always buyers and sellers available, which helps stabilize prices and keep the market functioning smoothly. But even with market makers providing liquidity, the price is still ultimately determined by the orders that come into the market. If a large institutional investor wants to buy 1 million shares of a stock, they cannot just place one market order. That would blow through all the available asks at the current price and drive the price way up. Instead, they might spread the order out over time or use algorithms to execute it gradually. The way large orders are handled reveals a deeper truth about price. The price you see on your screen is not a single static number. Depending on context, it may refer to the last traded price, the current best bid, the current best ask, or a consolidated price across multiple exchanges. This brings us to the concept of price discovery. Price discovery is the process by which buyers and sellers arrive at a transaction price. It is the mechanism through which markets incorporate information into prices. When new information enters the market, buyers and sellers adjust their bids and asks, and the price discovers a new level. This process is continuous and dynamic. It reflects the collective actions and expectations of all market participants. The goal of price discovery is not to find one permanent, exact price, but to continuously reflect the price level at which buyers and sellers are prepared to transact under current market conditions. The efficiency of this process depends on liquidity. In highly liquid stocks like Apple or Microsoft, large volumes of shares trade regularly. Price discovery is generally efficient. The bid-ask spread is narrow, and prices react quickly to new information. In smaller, less liquid stocks, there may be fewer buyers and sellers. This environment can make price discovery less efficient. A single large buy or sell order can move the share price sharply. This is why you will sometimes see a stock gap up or down on no news at all. It is not that something fundamental changed about the company. It is that the order flow changed. Someone placed a large order, and the price adjusted to find a new level of agreement. So what does all of this mean for you as an investor? It means you should stop thinking of the stock price as a report card on the company. It is not. It is a snapshot of what the last buyer and seller agreed upon. It is a record of a transaction, not a judgment of value. When you see the price drop, it does not necessarily mean the company is failing. It might just mean that, in that moment, there were more sellers than buyers. When you see the price rise, it does not necessarily mean the company is thriving. It might just mean that, in that moment, there were more buyers than sellers. The price is a signal. It tells you what the market collectively thinks right now about the future. It incorporates everything that is known, and everything that is guessed, and everything that is feared, and everything that is hoped. It is influenced by earnings and interest rates and political events and social media sentiment and the mood of the moment. But it is not the truth. It is just the current consensus. And consensus can change in an instant. The important thing to understand about stock prices is not the number itself. The important thing is to understand that the number is the product of a process. It emerges from an auction. It is set by the highest price a buyer is willing to pay and the lowest price a seller is willing to accept at a given moment. It reflects one real transaction, not the full range of what everyone in the room would have paid. Once you understand this, the daily ups and downs of the market become much less confusing. You stop looking for someone to blame for the movement. You stop assuming that the price is always right. You start to see the market for what it is: a continuous conversation between buyers and sellers, each with their own expectations, each with their own information, each trying to find a price that works for them. And that conversation never stops.